Our economy will face its biggest challenge ever this decade, and most people don't even know what's coming. Our money, or at least what we call money, is being put to the test. Not because of inflation, not because of interest rates, but because of something called debt monetization. Let me explain. Our government doesn't earn money. It collects money through taxes by taxing people like you and me, and in 2022, the government generated about $5 trillion in taxes. Now, you might think that if the government generated this amount of money in taxes, they would do what any financially smart person would do, which is spend some of it, invest some of it, and save some of it. But that's not what we saw happen, because in 2022, the government spent about $6.5 trillion. This means that in 2022, the government spent about $1.5 trillion more than what it brought in. Now, this isn't really that surprising, because the government has been running a deficit like this for a very long time. The question is, who's paying for this additional spending? Because we know that out of the $6.5 trillion that the government spent, $5 trillion is from tax dollars that the government collected from people like you and me. But what about that last $1.5 trillion? Where did that money come from? Our government doesn't have the ability to create this money out of thin air. They have to get this money from somewhere, and the first place where the government might work to get this money is through people like you and me, through something called a treasury bond, which is a loan to the government. You and I have the ability to loan money through the government in the form of a treasury bond, and then the government would pay us back with interest. But many times that's not enough. That's when our government might call up their friends at the Japanese government and the Chinese government, who are the biggest foreign lenders to the United States, and ask them for more money. But that's typically not enough either. That's when our government will call up their good friends at the Federal Reserve Bank, who is our central bank here at the United States. Now, while they're called the Federal Reserve Bank, they're not federal. It says so on their website. They're not a reserve because they don't keep cash reserves, and they're not a bank. You and I can't go there to deposit money. That being said, the Federal Reserve Bank does have some special powers, which includes having the ability to essentially print money and give this money to the government to cover this deficit spending. This is called debt monetization, because now the Federal Reserve Bank can print money essentially out of thin air and give it to the government. That way the government can spend more than what they bring in. Now, you might hear that and say, well, Jaspreet, if the government can just get whatever money that they want from the Federal Reserve Bank, why do we have to pay taxes in the first place? Well, because there's a cost to the Federal Reserve Bank printing this money and giving it to the government. And it's still a tax, because all money for the government is paid for by taxpayers. So when the government spends money that they don't have, you're still paying a tax. Now it's just a hidden tax. This hidden tax is inflation, because when you print more money without creating more wealth, you're printing more of these pieces of paper while the actual wealth that we have doesn't increase. So now when you have more money but not more wealth, the value and buying power of each individual dollar goes down, causing the price of things to go up. But there has to be a consequence to all of this, right? I mean, we're approaching $32 trillion worth of national debt. Is there a limit to how much the government can really spend? Before I answer that, let me highlight one thing, because I think this will help you understand what's going on. Remember, the Federal Reserve Bank is not a federal government entity. They're a separate entity over here. We have our government over here, and then we have our taxpayers over here. We have our male followers with a mustache, or as we like to call it in our native language Punjabi, a much, and our female followers with a braid, or as we call it in my native language Punjabi, a gut. So you go to work to get paid. You make money and you pay the government taxes. The government spends this money plus more with the help of the government's money printing. Well, is there a limit to this type of debt monetization? By the way, the reason why it's called debt monetization is because the Federal Reserve Bank is buying the debts of the government. In 2017, Janet Yellen was the chairman of the Federal Reserve Bank, and we had roughly $20 trillion worth of national debt, and she went out publicly and said that this amount of national debt that we have should keep you up at night because of the amount of national debt that we had. Now remember, she was the chairman of the Federal Reserve Bank. She wasn't a part of the government. She was a part of this entity. By 2021, two things happened. For one, the then chairman of the Federal Reserve Bank, Janet Yellen, moved from the Federal Reserve Bank to the Treasury Secretary here inside of the government. And then we were approaching the high $20 trillion of national debt. And then Janet Yellen was then asked again about the national debt levels when we had high $20 trillion of national debt. And what she said was, well, this national debt is no longer a problem because our government can support this higher national debt, especially because back then in 2021, Interest rates were at their lowest levels ever, so these interest payments on these debts are not that big of a deal. Now here we are today in 2023, we are approaching $32 trillion worth of national debt, and now the interest payments of the national debts are starting to creep up, and now the question is, when is the national debt going to become a problem? And the real answer to that is too much debt is not a problem until it becomes a problem. See, when the government spends money that it doesn't have through this debt monetization, it has to pay this money back, plus interest. It can't just ignore these payments because, well, there are the major countries in the world that are loaning money to the United States. You have investors inside of the United States that are loaning money to the United States government. And we are the largest and strongest economy in the world, so we are under this impression that we are always going to pay this money back. But how does the government pay this money back? Well, if you remember what I had on the screen just a second ago, the government gets its money from taxpayers. That means when the government gets your tax dollars, more and more of your tax dollars have to go to pay off the government's interest instead of funding government operations. Now, my team at Market Briefs has been covering what's going on with government debt and interest payments in Market Briefs, which is my free financial newsletter. But in 2021, our interest payments from the United States government were right around $352 billion. In 2022, our interest payments jumped up to $475 billion. By the way, if you haven't joined Market Briefs yet, it's a free financial newsletter that I created to help you stay up to date on what's happening in things like our economy, our stock market, our housing market, crypto, and the global economy. It's a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you want to join Market Briefs, I'll put the link to how you can join for free down in the description below. This means that in 2022, we spent more money in interest payments than we did on Veterans Affairs and transportation in the country combined. Now, again, right now, this $475 billion interest payment isn't really that big of a deal because we're able to manage that. But remember what I said just a minute ago. Too much debt isn't a problem until it becomes a problem. What it looks like right now is that by 2025 and 2026, our interest payments are going to exceed our entire military budget. But even that is still not the major problem. Now, the reason why we're seeing our interest payments rise so quickly is for a couple of reasons. For one, we keep spending more money that we bring in, so our national debt rises, so our debt level, our debt balance is increasing, and at the same time, our interest rates on these debts are rising. The Federal Reserve Bank is working to raise interest rates as a way to bring down inflation, and our government national debt, our almost $32 trillion worth of national debt, is not a 30-year fixed rate mortgage. Some of this debt readjusts every month, some of this every 6 months, some of this every year, some of this every 5 years, some of this every 10 years. So every 6 months or so, we're seeing another chunk of our national debt readjust at the higher interest rates, which also means that the interest payments are rising. So our interest payments are rising because one, the interest rate on our debt is rising, and two, because our balance of the debt is rising as well. Now again, that by itself isn't a big deal because too much debt isn't a problem until it becomes a problem, and as long as revenues are rising for the government, meaning tax revenue is rising, then it's okay because they can keep making the payments. The problem is we're facing an economic slowdown, a potential recession if we're not already in a recession, which means that profits fall, incomes fall, and if we see profits and incomes fall, that means tax revenues fall at a time when expenses are rising. But there's one more major factor which makes this even more interesting. We have some countries around the world, notably the BRICS nations, which are Brazil, Russia, India, China, and South Africa, that have been noticing that our government debt levels are rising, that our interest payments are rising, that we've been printing a lot of money, and now they're working to diversify themselves away from the United States, and these BRICS nations have been working to develop their own reserve currency. Right now, the world reserve currency is the dollar, but you're starting to see more and more countries around the world that are trying to treat this like an economic weakness for the United States, and they're trying to create their own reserve currency, and this new reserve currency looks like it might be backed by physical gold. Now, our money, or what we call money here in the United States, isn't backed by physical gold. It's not backed by any metal. It used to be back before 1971, but today it's just backed by a promise from the United States government that our money has value. Because before 1971, our dollars were backed by physical gold. If the Federal Reserve Bank wanted to print more money, well, we needed more gold. We need more wealth. It was a way to protect against inflation because then you couldn't just print money on command. Well, the problem that happened was leading up to 1971, we had a lot of debts here in the United States, and a lot of countries around the world were demanding payments. They were demanding gold because they lent money to the United States. And that was when President Richard Nixon in 1971 took the dollar off of the gold standard, which now meant that the government and the Federal Reserve Bank had the ability to print and spend money on command, because now you no longer needed the physical gold. So now the government could spend whatever amounts of money that they wanted, the Federal Reserve Bank could print whatever money they wanted, the government could then pay back all their debts, and there was no big deal. The problem was that it created a lot of inflation, but the government was able to spend whatever amounts of money that they wanted. Now you have these nations around the world saying, it looks like the United States government could be facing potential issues in the future with all the money printing and their debt costs. And now they're looking to create their own reserve currency backed by physical gold. In 2022, we saw central banks around the world hoard and purchase more gold than really ever before. This is the most gold purchases by the central banks since, well, the early 1970s. This brings us to the ultimate question of how is this going to affect the value of the dollar, and what does this mean for you, and what can you do? Well, when you have high inflation, it reduces the value of the dollar, which ultimately causes the price of things to go up. Now, yes, we are seeing the Federal Reserve Bank work to increase interest rates as a way to bring inflation down. Inflation has come down off its highs, but inflation is still very high. This is coming at a time where we're also seeing a lot of worries and concerns about where our economy is headed. And so if our economy continues to go down, well, that could force the Federal Reserve Bank to potentially pivot and start inflating at a time where our economy is slowing, but inflation is still high. So there's a lot of uncertainties as to what could happen to the value of the dollar. But what this means for you is really now, again, the importance of financial education and why you want to be investing your money and why you want to be preparing to invest your money instead of just hoarding cash. Because at the end of the day, cash has lost value for the last century versus investments, whether it's stocks, whether it's real estate, whether even if it's some physical gold. These investments have gone up in value, or at least price. Like gold doesn't create more value. You just see that as the currency value or dollar value goes down, the price of gold goes up. Now, I personally own gold, but I don't own a huge chunk of gold. About 2% of my total investment portfolio is gold. I don't consider it an investment. For me, gold is my insurance. It's a hedge. It's an alternative way for me to save money, because now I can save hard money, something that I can see, feel, and touch. Do I really care what's happening with the price of gold? No, I don't care if it goes up or down. I'm just accumulating a little bit of gold. There's a small piece of my portfolio as insurance against worst case scenario protection. That's why I own physical gold. But again, this is why financial education is so important. That way now you can take your cash and put it into an asset, something that's working to bring you value. Of course, this is now where how do you invest, when do you invest, and what do you invest in is so important. And I have a ton of videos on my channel that go over this type of financial education, because now it pays to be aware of what's happening. We keep you updated on market briefs, but then it also pays to use your money smartly. That means live below your means, have a savings cushion to protect you against a financial emergency, and then have cash put aside to be able to capitalize on distressed assets that might come your way. That way you can use the system to your advantage instead of just being the person that gets screwed over by the system. Inflation disproportionately hurts the middle class. It disproportionately hurts the poor, and it disproportionately hurts the financially uneducated, while inflation disproportionately benefits the wealthy and the financially educated, because when you understand inflation, well, now you can benefit from it because you can own the assets. You can own investments.